Hello, and welcome to the Capital Stewards podcast. Occasionally, actually frequently, I think now, I get Instagram reels and other social media content sent my way from our clients and from our friends. Sometimes it looks like a social media influencer standing in front of a private jet explaining how they made their first $1 million in like 14 days, doing something with crypto or real estate or something else that sounds kind of wild. And today I want to tell you with 100% certainty, if you see a piece of social media content about financial decision making and it includes a private jet, that's your signal to close the app and go do something else. Those videos are entertainment. They're not financial education. And I say that not to be a killjoy, because today we're going to talk about how multi-generational wealth is built, what it actually looks like, and it looks nothing like what's on your phone at 11 o'clock at night. Also, building multi-generational wealth is not just for famous families or tech founders. It can be for everyone if you do it right. So today, we're going to kick off a multi-part series on multi-generational wealth, how to build it, how to steward it, and it's not going to involve jets or Italian sports cars or anything like that. So let's dive in. Before we get into the mechanics of wealth building, I want to start with a simple question. What does multi-generational wealth actually mean? Because I feel like people hear that phrase and they immediately think Rockefellers, Vanderbilts, old money, family estates. And that framing stops a lot of people before they even start. They think that's not for me, that's for other people. But that's not what we're talking about. Multi-generational wealth is simply about building assets that provide opportunities and flexibility for your family over time. That doesn't mean that your kids never work. It doesn't mean that they're automatically spoiled. And you definitely don't need to have buildings named after you. I like to frame it as creating a foundation that changes what's possible for your family down the road. It's about options. It's about your kids having the financial flexibility to take risks, pursue what they love, be generous with their communities, and weather difficult seasons of life without having to start from zero. So that's what we mean when we say generational wealth. And the truth is, I think more families can build it than most people believe. So let's start with some basics, and maybe before we talk about what we should do to accomplish this goal, let's maybe back up and talk about what it's not. Because I think it's actually important that we kind of sort of push to the side some of these narratives that are out there that just, frankly, just aren't true, right? So generational wealth is not built through flipping stuff, trading, quick wins, or really any scheme that promises fast returns. The people that are building real lasting wealth almost always have a story that took years, sometimes even decades, to develop. What looks like an overnight success in the news was almost always 10 or 15 years of building in the background. And then there's this tipping point that happens. That's the moment when people noticed. And that seems really sudden overnight, but the building wasn't. You don't need a novel idea here, though. You don't need to invent the next big thing. You don't need to be a uniquely talented person either. I think, that's another big misconception. Most multi-generational wealth is built by ordinary people who apply the right principles over a long enough period of time. And that's the message that I want you to walk away with here today. So let's talk about 6 principles for actually building generational wealth. The first, I would say, is kind of the most fundamental principle, and that is to stop optimizing for income and start optimizing for assets. And that sounds simple, but it's not simple to actually do. Most of us are wired by school, by our parents, how our careers are structured, to think in terms of income. The raise, the promotion, the bonus. Income is how we measure success. But here's the problem. Income requires you to keep showing up. The moment you stop, it stops. The clock in, clock out model, right? Even if you're well compensated and you don't, technically punch a clock, you're still fundamentally trading your time for money. And that's fine. It's how most of us start out, but that's not how generational wealth is built. Assets work differently. An asset produces value whether or not you show up. Your investment portfolio goes up and down while you're on vacation. A rental property generates rent while you sleep. A business generates cash flow on Saturday morning while you're at your kids' soccer games. So the goal is to shift from being the income producing engine, for your family, to owning the income producing engines. That's what people mean when they talk about entrepreneurs who are not trading time for money anymore. They build something that produces without them being directly involved every single hour of the day. Now, assets still need to be managed. So don't mistake this sort of not clocking in for passive, or, you can just sort of do something on the side. That's not what this is. But the relationship between your time and the value that's being created can be fundamentally different. So if you're not building assets today, it starts with asking, a different question every time you make a financial decision. Instead of asking, how can I earn more? You start asking yourself, how can I own more? Every dollar that comes in, you start thinking about it as potential capital. what could this asset or dollar help me buy or build? That's a real shift in how you see sort of money. Now let's talk about buying assets. You need capital to do that, and that's where saving comes in, right? But saving for multi-generational wealth looks very different from saving for retirement. And I talk a lot about retirement and retirement strategies and all those kinds of things. And so this is very different than that, right? So we have different goals when we're talking about multi-generational wealth building versus saving for retirement. So I just want to call that out here because a lot of you might be thinking, well, I'm saving for retirement and this is kind of different, right? The goals are different. And if you have different goals, you should be taking different financial steps, right? Standard retirement savings advice, it kind of looks like this. Figure out how much income you'll need in retirement and work backwards to identify a savings rate, usually somewhere between 10 and 15% of your income that's doable, and then invest that over, say, 30 years. The whole approach is optimized around how little do I have to save and still make it to retirement comfortably. And that works great if retirement is your goal. But multi-generational wealth building requires a completely different question. Instead of saying, how little can I save and retire, you've got to ask, how little can I spend right now so that I can save as much as possible to build capital? And that's a fundamentally different framing. I call that building the wedge. The wedge is the gap between your income and your expenses. Most people let lifestyle inflation shrink that gap over time. You earn more, you buy a bigger house. That bigger house requires more furniture. Maybe you have to hire some people to help you clean it, right? It's easy to let lifestyle inflation sort of creep in around the edges over time. The people that are building generational wealth widen that gap intentionally. They fight lifestyle inflation and then they deploy those savings into assets. Saving like this though is not glamorous. I think it's really easy, to maybe think that, right? Short-term sacrifices are real. You might not take that expensive vacation. You might not you might have to drive a car for a few extra years. You might not get a new one, right? You eat out less. None of that sounds exciting while you're doing it. But I think one way to maybe help you frame it that might help you, when it feels not so fun, right? Is to just visualize the impact that you could have on your kids and on your grandkids and on those options and about those options that you're creating for them. A few years of spending less now starts to feel like a pretty reasonable trade. It also helps to be practical when we start talking about saving, a bit practical about the math. Most of the assets that we're going to talk about, real estate, small businesses, they require pretty meaningful capital. And you're probably not going to be able to save up enough capital, at least over a several year time span, to buy an asset outright for cash. So that's where we start talking about debt. Because what's a more reasonable savings goal is say, hey, I want to save, 10, 15, or 20% of the value of some asset that I want to go buy. That's sort of a more realistic goal. So I do think that if you're focused on saving as much as you can save, and then you set a realistic goal of I need to save a lot, but I don't have to get all the way there. I can maybe pair my savings with some debt. Then you can actually get to a place where you're buying those assets, kind of tying it back to our first principle. So let's talk about debt and down payments for a minute, because I feel like this is where people have really strong opinions. You may have already started to think it in the back of your mind as I was talking a second ago. I hear two completely different camps all the time. One camp says, never have debt, pay off everything, be debt free. The other camp says use debt aggressively to build wealth. And I land squarely in the camp of debt is a tool, not a moral prerogative. And the reason people have such strong feelings about debt is that most people's first experience with debt is consumer debt, credit card balances, car loans, student loans. And that kind of debt, generally you're using it to buy things that have no lasting value, right? Those things depreciate over time. They're worth less the day after you buy them. And that destroys wealth. So when people say debt is bad, that's where that belief comes from. And it's a reasonable conclusion because that's the experience that most folks have with debt. But there is a different kind of debt, and that's debt that's used to acquire income producing assets. And that's categorically different. Now, if you think about it this way, if you have $100,000 saved and you want to buy a rental property worth $400,000, using leverage lets you own that asset today instead of waiting for years and years to save the full amount. And here's the key insight. If that property appreciates and generates rental income, you're earning returns on the full $400,000, not just your $100,000. And that's how strategic debt amplifies wealth creation. Think about Berkshire Hathaway for a minute. Warren Buffett's probably the most celebrated investor in history. Berkshire carries hundreds of billions of dollars in debt by choice. Even though a lot of times they have enough cash to pay all of it or most of it off, they use debt as a tool to generate better outcomes. If the most successful long-term wealth builder in modern history thinks debt is a tool worth using, then maybe it's worth rethinking the sort of all debt is bad narrative that you might have brought into this conversation. But there's obviously a wrong way to use it too. I think of debt like a power tool. In the right hands with the right skills, it builds things faster and better. But if I give a power tool to my 5-year-old, bad things are going to happen, right? So if you know, you've got to be disciplined in how you're deploying debt in order to get good results. You've got to be disciplined to only use it when you acquire assets that have real income potential. You got to keep the sort of debt level manageable, even if you're buying assets that should appreciate. You still have to be thoughtful about how you do that. And then, of course, you never ever want to use debt to fund lifestyle spending. So, principle 4. So let's talk about owning the right assets. What do we actually buy once we've got the right capital saved and some capability to go borrow? For most families building multi-generational wealth, it comes down to 2 categories: businesses and real estate. A standard retirement portfolio of index funds is a great foundation, but honestly, the returns from a diversified stock portfolio are solid. They're not transformational. To build real generational wealth, you need concentrated positions in assets that have more upside. That seems to go against a lot of conventional thinking about, sort of diversified indexing, things that I subscribe to, right? Index funds, all those kinds of things. But different goals, again, require different strategies. So when we start with retirement portfolios from folks that have already built a significant amount of capital, they're already in the diversification stage of their life. They're already in the place in their life where they want to take less risk, still see some growth, and not have the potential to sort of lose their entire nest egg. This is a different thing that we're talking about here, right? Diversification is important over time. We're going to talk about that in a few minutes, but you probably can't start the wealth building process with a diversified portfolio. Let's start with businesses, because I think people immediately assume too that you have to invent something new, right? And this is one of my favorite myths to kind of debunk. Our own firm is a good example of this. We're not the first fiduciary investment firm in the world, but we are the only one in our community with a specific focus around faith-based planning, stewardship, multi-generational outcomes, those kinds of things. That's not a new idea. It's an existing idea that's deployed in a specific way for a specific audience. The opportunity that you're looking for might be something you've seen somewhere else that doesn't exist in your neighborhood, in your community, or even in your community. If you think broader, outside of your geography, perhaps your industry community or community of folks that you know from around the U.S., right? What doesn't exist within that community that you've seen thrive somewhere else? Restaurants, service businesses, franchise concepts, those can all be legitimate first businesses. It can also be something that that isn't a franchise or that you create. But let's be honest about starting new businesses, right? SBA data, Small Business Administration data, says about 20% of all new businesses, startup businesses, fail within the first 2 years, and 65% close within a decade. Those numbers are pretty sobering. So it's really difficult to start from nothing. So is there an alternative to that? Buying an existing business with a proven business model is an alternative. What I say a lot is that going from zero cash flow to positive cash flow is actually incredibly hard. I've done it myself. I don't recommend it. Going from positive cash flow to buying, to more cash flow is actually a lot more manageable. And when you buy an existing business, you're building a proven concept with existing customers, existing revenue. Then you can shape the culture, grow it, improve it. And there's lots of businesses that are listed for sale online, Biz Buy Sale. There's other platforms that are out there. There's lots of owners that are looking to retire. And so there's lots of opportunity to acquire as well if you don't want to start from scratch or if you want to take a little bit less risk. The other major asset class is real estate, right? And I want to be clear, real estate investing is not passive, despite how it's often marketed. Managing properties, dealing with tenants, handling maintenance, navigating the market, all that takes real work. But real estate has some unique advantages that make it particularly powerful for generational wealth building. There's implicit leverage in real estate. It's easier to borrow on properties, recurring income, long-term appreciation. There's also a lot of unique tax benefits with real estate we'll get into in one of the next segments when we talk more about estate planning. So there's a lot of goodness in real estate that is unique to it in the business context. So ideally, you're building towards owning both businesses and real estate. And that brings us to our next principle, which is to diversify over time. Because everything I've talked about so far is pretty concentrated. You're putting a lot or everything into one thing and you're taking a lot of risk. And that concentrated risk is often how that generational wealth gets built. When you're early in the process, you're going all in, one rental property, 2 rental properties, one business concept. And then that concentration is where the big returns come from if you win. But concentration also means that one bad year, one lawsuit, one industry downturn, financial crisis, something you didn't even create, can wipe out a significant portion of what you've built. So once you've built meaningful cash flow from that initial asset, you've got to start deploying it into different asset types. You got to start with real estate. Maybe you acquire a small business. You can something you can hire an operator for. If you started a business, maybe you start building a portfolio of public equities, or you start adding real estate, right? And the goal over time is to have multiple streams of income from multiple asset classes so that no single decision, no single bad break can kind of end this journey. So you start concentrated to generate returns, and then you diversify over time to protect them. And then last principle for today, and honestly, this might be the hardest for most people, is time. Obviously, we live in a culture that is obsessed with speed, instant results, overnight success, 30-day transformations, right? All that stuff. None of this is how wealth is built. The Bureau of Labor Statistics, right? We talked about this earlier, right? Tons of businesses fail, and a lot of them fail pretty quickly. A lot of entrepreneurs are going to fail once or twice before they find the thing that works. And then for businesses that do survive, sometimes it takes 2 or 3 years to sort of generate meaningful profits. And same thing, real estate, it can take years for real estate before the math sort of starts to tip in your favor. That's a long time. And I think people don't think about the time component of building wealth. The stories that we hear, like I said, in the upfront, a lot of times it's overnight success, right? But we don't hear about sort of the decade of quiet building that happened to get to that big headline. But that's the real story of generational wealth. Patience is not a passive thing. It's an active discipline. You've got to stay the course when things are hard, not selling assets prematurely, continuing to invest, even though you don't see the returns yet until you get to the other side. All right, so that's a lot for today. Let's try to summarize everything. So we'll talk about our 6 principles here. So first, shift from optimizing income to acquiring assets. Second, we want to build the wedge. We want to widen the gap between your spending and your savings. Third, treat debt as a tool, not a moral prerogative. Fourth, focus on business and real estate as those primary wealth building vehicles. And then fifth, diversify over time. You start concentrated and then protect it by spreading it out down the road. And then sixth, give it time, right? More time than you think, more time than feels comfortable. And that's how we build wealth over time. So that's a really solid 6-step framework. And like I said at the beginning, none of that requires a private jet or anything from Italy to build multi-generational wealth. So before I wrap up this episode, I hinted earlier at something I think a lot of you are going to want to hear more about. We've been talking about building wealth, but there's this other question that comes up for families who are succeeding at building the wealth, and that is, how do I transfer it to the next generation without ruining them? And it's a question I get almost every time I sit down with a family that's got meaningful assets. We've worked so hard to build this. Our kids are great. We love them, but we don't want to mess up the transfer. We don't want to mess them up. We don't want to mess up the business, all those kinds of things. And there's a lot of things you can do to prevent the wealth transfer process from going off the rails, but it requires intentionality and it requires starting a lot earlier than most people think. And so that's what we're going to talk about in the next episode. We'll talk about how to raise the next generation as stewards, not recipients of everything that you've built. And then we'll get into the practical side of wealth transfer, estate planning, tax strategies, charitable structures, a bunch of other stuff that'll be really, really relevant. So that's what's coming up on the next episode. So I hope this conversation was helpful as you start thinking about, maybe getting outside of retirement planning a little bit, thinking about how do you build a wealth when you're thinking about your kids and their kids and your family long term. And we will see you on the next episode of the Capital Stewards podcast.